This is a solutions video for the monetary policy and the money multiplier worksheet. Now the first part asks you to draw the model of the money market and the aggregate supply aggregate demand model and show how those two can link up to illustrate how a change in the money supply can close an inflationary gap. So the first important thing with this is you're going to draw your money market graph, and you got to draw your curves correctly and you got to label them. So go ahead and draw your Y and X axis. Make sure that you label your Y axis nominal interest rate, because we're talking about the M1 money supply, which when people get M1 money in their pocket, they tend to spend. And so it's nominal instead of real, because we don't have to worry about accounting for inflation, because this money is not going to be around in people's pockets long enough for inflation to eat away at the value of it. So nominal interest rate is on the Y axis, and the quantity of M1 money is going to be on the X axis. Remember that the demand for money is downward sloping because of the inverse relationship between nominal interest rates and the quantity of M1 money demanded. But don't forget, the money supply curve is vertical because that is going to be set by the Federal Reserve. And so it's independent of interest rates. It just is what it is, set by the Federal Reserve. Where they meet is going to be the equilibrium nominal interest rate. Now, to close an inflationary gap, that means that the Federal Reserve is going to need to decrease the money supply because the economy is already going too fast and the circle is already spinning too fast. And so when the Federal Reserve decreases that money supply, that's going to shift the money supply curve to the left, which means that the nominal interest rates are going to rise. Now let's talk through this chain of events. Understanding and being able to explain and write this chain of events is very important, and is also the way you're going to answer a lot of free response parts. Whenever the money supply shifts to the left, whenever the money supply decreases, that is going to increase the nominal interest rate. When the nominal interest rates increase, that means that people are less likely to go to the banks and get loans because of these expensive interest rates. When people don't get these loans, whenever businesses don't go to the banks and get loans so that they can get machines and physical capital for their businesses, when consumers don't go to the banks and get loans for cars or for houses or for renovations on houses, that means that there's not going to be as much I and C spending as there would be if these people actually got those loans. Since they never got the loan, they never got the money to spend, so they're not spending. So I and C are going to decrease. And I and C are components of aggregate demand, so that decrease in I and C is going to shift your aggregate demand to the left. Now we want to show this on the aggregate demand, aggregate supply model. Make sure you're drawing your aggregate demand, aggregate supply model correctly with everything labeled. You want to have price level on your y-axis, you want to have the real GDP on your x-axis, and you're going to have your downward sloping aggregate demand curve and your upward sloping short-run aggregate supply curve. Now, before we go and draw this at full employment, before we go and draw that long-run aggregate supply going straight down the middle, remember that we are trying to close an inflationary gap. That means we need to show that we're already in an inflationary situation. And the easiest way to draw that is just take your long-run aggregate supply curve and just draw it a little to the left. The reason why drawing your long-run aggregate supply a little to the left of where aggregate demand and short-run aggregate supply intersect is because we're trying to show that the current equilibrium where aggregate demand and short-run aggregate supply intersect is at a real GDP level that is higher than full employment level. Now, whenever the Federal Reserve decreases the money supply and that increases nominal interest rates, which is going to decrease I and C, it's going to decrease aggregate demand. So on this graph, we're going to shift our aggregate demand over to the left, and notice how that's going to lead to a decrease in price level, and it's going to lead to a decrease in real GDP, which is going to also mean there's going to be an increase in unemployment. Now, of the toolbox, what are the 3 ways the Federal Reserve could make this money supply decrease? Well, using their tools, with the first tool, reserve requirement, they could increase the reserve requirement, which means that banks need to hold on to more money. When banks hold on to more money, less money is out there in circulation, so the M1 money supply decreases. They could also increase the discount rate. When the discount rate increases, that means it's more expensive for banks to get a loan from the Federal Reserve. Banks don't get as much money from the Federal Reserve, so they don't have as much money to loan out, so there's less money in M1 circulation. Or if the Federal Reserve wants to use its favorite tool, open market operations, then we want to make the money supply smaller so the Federal Reserve could sell bonds. So if you take a look at the middle part of this worksheet, this is just kind of a summary, just kind of a recap for you to get your bearing on these tools. Notice that I ask you, what are the ways it can use its 3 tools to increase and decrease the money supply? Well, if the Federal Reserve was trying to increase the M1 money supply, then for the reserve requirement, they would totally lower that. By banks not hanging on to as much money, more money can be loaned out and put in hands and put in circulation. They would also lower the discount rate. By lowering the discount rate, more banks could borrow more money from the Federal Reserve, and if banks have more money, they have more money to loan out and put in the money supply. Finally, with open market operations, we know that if they're trying to make the economy and the money supply bigger, then they want to buy bonds, because buying bonds makes the money supply bigger and puts money back into the hands of people. If the Federal Reserve is trying to decrease the money supply, then just like we saw in the first part of this worksheet, they're either going to increase the reserve requirement, which means that banks have to hold on to more money and they can't loan out as much, so less money is going into circulation. They would increase the discount rate, which means that banks can't afford to borrow as much money from the Federal Reserve, which means they don't have as much to loan out, and that's less money in circulation. Or if the Federal Reserve wants to use open market operations, which is buying and selling bonds, then that means that they want to make the money supply smaller by selling bonds. Remember, when they sell bonds, they're taking money out of people's hands and giving them these useless little white blank index cards like I gave y'all. Finally, the last part of this worksheet, I have you doing a little bit of practice with the money multiplier, just a little bit of math practice with the money multiplier. Remember that by now we've been doing multipliers for a while. You're starting to see the same numbers. You're going to see the same numbers over and over again because there's no calculators used on the AP exam, so there's only a certain amount of multipliers we can do in our head, right? So in this first question, it says, if the Fed buys back $100 billion worth of bonds and the reserve requirement is 10%, then what's going to be the total change in the money supply resulting from this? And we don't have to worry about waiting or skipping around or anything like that. The Fed is buying these bonds and is putting money directly into the M1 money supply, directly into the hands of people. We're going to take this total amount that they're buying back, the $100 billion worth of bonds. We're going to multiply that full amount by the multiplier. Now our reserve requirement is 10%, so to find our money multiplier, we're going to do 1 over the reserve requirement. That's 1 over RR, which is 1 over 0.1, 1 over a tenth. Our multiplier is going to be 10. So we're going to take that full 100 billion and we're going to multiply it by 10, and we can see that the impact of this is going to be 1,000 billion or $1 trillion increase in the M1 money supply. Now check out number 2. Now if Jack deposits $50,000 into his checking account and the reserve requirement is 10%, what's going to be the total impact from this action on the money supply? Well, the reserve requirement is 10%, so just like in the previous question, our multiplier is still going to be 10, but we're definitely not going to do 50,000 times 10. That's because the bank can't loan out the entire 50,000 and put that into circulation through loans. The bank has to hang on to 10% of the 50,000, which is 5,000. So whenever Jack deposits 50,000 in his checking account, the bank's going to hold 5,000, 10% of that in reserves, and then they're going to only be able to loan out the remaining 45,000. So we're not going to do 50,000 times 10. We're going to do 45,000 times 10, which is the amount of money the bank can actually loan out and put out there in circulation from his initial deposit. Well, 45,000 times 10, whenever Jack put $50,000 in his checking account, that means that it resulted in a 450,000 increase in the M1 money supply because of fractional reserve banking. Finally, I have a little chart just for you to practice this a little bit more. I'm going to go through and talk about the multiplier in the third column. Now, remember that when you're trying to find the money multiplier, you're going to do 1 over the reserve ratio or the reserve requirement. And so the first one, the reserve requirement is 10%. 1 over 0.1 or 1 over 1/10, your multiplier is going to be 10 on that first one. For the second one, your reserve requirement is 20%. 1 over 0.2 is going to be 1 over 1/5, so your multiplier is going to be 5. For the third one, your reserve requirement is 50%. That's going to be 1 over 0.5 or 1 over 1/2, which means your multiplier is going to be 2. On the fourth one, the reserve requirement is 100%. So basically this means that banks have to hold on to 100% of whatever is deposited. They can't really lend out any money. Since they can't lend out as much money, the impact on the money supply is definitely going to be very weak. They're basically holding everything in their bank. For that, we're just simply going to do 1 over 1, which is going to be 1. So the multiplier is just going to be 1, whatever initially happened. Finally, for the fifth one, the reserve requirement is back to 10%. And so just like we had in the first one, that's 1 over 1/10, so our multiplier is going to be 10. Now let's find out the impact of these actions. So in the first one, the Fed is buying $80 worth of bonds. Now that $80, that full $80 is going to be multiplied by 10, which is the money multiplier. And so that means that that Fed's actions is going to increase the money supply by a positive $800. In the second one, the Fed is selling $100 worth of bonds. Remember, when the Fed sells bonds, that's going to shrink the money supply, sell small. So when the Federal Reserve sells $100 worth of bonds and the multiplier is 5, that 100 times 5, that's going to lead to a decrease in the money supply of $500. In the third example, the Federal Reserve is buying $30 worth of bonds. Buying means bigger money supply. And so we're going to take this whole $30, we're going to multiply it by the multiplier of 2. That means that the Fed's actions is going to increase the money supply by $60. In the fourth one, the Fed is selling $20 worth of bonds. Whenever the Fed sells, that's going to make the money supply smaller, so it's a decrease. So $20 worth of bonds times your multiplier of just 1, that means that this is going to decrease the money supply just by $20. Finally, in the last one, you deposit $50 into your checking account in the bank. Now, when you deposit that $50 into your checking account, the bank is going to have to keep 10% of that because that's the reserve requirement. They have to keep $5 of that. And so the bank is only able to lend out 45 of the 50 that you deposited in your checking account. So we're not doing 50 times the multiplier of 10, we're doing 45 times the multiplier of 10 because that's what the bank can actually lend out and get out there in circulation. 45 times 10, that means that when you deposited $50 into your checking account, the result of that would be an increase in the money supply of $450. Hopefully this practice helps you out and gives you a little bit more hands-on experience with the money multiplier. Hopefully you're starting to see that it's very similar to the spending multiplier. We're going to keep working on this, but you're going to see multiplier not only in multiple choice questions, but also you're going to see it as components of free response questions.